12:30.
Okay. Good afternoon, everyone. Welcome to the Investor Relation Talk Cromwell EU REITs webinar. Thank you for spending your valuable time to attend this webinar. My name is Jeff from Retail Marketing and Investment Bank. Please do allow me to introduce Cromwell EU REITs with some brief info. This company is the largest Singapore-listed REITs with a 100% European commercial real estate portfolio of 2.4 billion euro. The REIT owns 110 predominantly freehold, a mix of logistic, industrial, and a Grade A office properties in or close to major gateway cities in the Netherlands, Italy, France, Poland, Germany, Finland, Denmark, Slovakia, the Czech Republic, and the United Kingdom, with an aggregate lettable area of approximately 1.9 million square meter and 800 plus tenant customers. CEREIT currently targets a majority investment weighting to the light industrial logistics sector, while also investing in a core office asset in the gateway cities. We have here with me today the CEO of the manager, Mr. Simon Gehring, and as well as CFO, Mr. Shane Hagen. I will hand it to you, Mr. Simon.
Thank you, Jeff, and thank you to AM Bank for arranging this opportunity for us today to talk to your clients and investors. So we appreciate the time. We thought we would run through maybe 20 minutes worth of slides to provide investors with an overview about the REIT, the investment proposition of why buy this REIT, what's so special about this particular one relative to the other 42 or so other Singapore REITs. What we wanted to show with this first slide, Jeff has nicely summarized, which is we have over 110 properties throughout Europe. The average size is around 25 million euros. At the moment, that is, a very liquid space to be in from a transaction perspective. You'll see a lot of resilience and diversification come through our slides. We provide a high dividend yield. So to continue to provide that high dividend, we need to demonstrate to you that we have a very high credit quality roster of tenants that will continue to pay their rent in good times and in not so good times. And we've now got a track record of the last 6 years, even during the depths of COVID in 2020, where the tenants were typically paying their rent and still having very high levels of occupancy. We will also talk today about the benefits of logistics and the tailwinds of logistics, that some of the themes may be very typical themes, and then there's some nuanced themes, particularly with Europe and onshoring. And then in office, we just wanted to highlight again that in Grade A office, the average vacancy in the markets that we operate in is only 3.5%, 3.5%. So we're certainly operating in very mature cities where there's not a lot of new supply. And post-COVID, you'll see us talk a lot about this move from the cheaper Grade B and Grade C space to the higher amenity, lower running cost Grade A buildings. And so there's this switch from tenant demand underway at the moment. But certainly 3 years ago, when we were only 30% weighted to logistics, one of the highlights from yesterday's results presentation is that we've reached that milestone of being now more than 50% weighted to logistics. And you'll see through the next few slides as to the benefit to investors for that. Go to the next page. Oh, it's a different presentation. So it's not the one that I emailed you. That's okay. So we go to the next page, page 4. Next page. Okay, so as a snapshot, why why are you listening in today? Well, firstly, we just announced a 7.79 euro cents distribution. On an annualized basis at today's price, that's a 10% yield. We have both the euro counter and the Singapore dollar counter on the SGX. So investors can choose whether or not they want to receive the dividend either in euro dollars or in Singapore dollars, depending on the type of bank account that you have set up. So about 70% of our investors elect to receive the euro. If you elect to receive the Sing dollar, then you're just converted at the spot rate at the time in September when the distribution is made. So 10% yield is the headline. The second headline here is our NAV is 2.3 per unit. And again, that's versus a share price today of 1.55. So the share price today is trading at a 35% discount to the NAV. So you would think with such a high yield and such a big discount to NAV that our income must be going backwards. So to put that behind us, we again in the middle column you can see that we delivered 3.9% like-for-like net property income growth, and in logistics in particular we delivered 8.7% like-for-like income growth. Office was about 1.2% positive. So high yield and with positive income growth. So then the other issue then is, well, what about your debt? You must be trading cheap because you've got debt problems. Well, the first thing we wanted to show is that we've been selling assets in the last few months and we've kept our gearing below 40%. We're investment grade rated by Fitch, and we now have no further debt expiries until the fourth quarter of 2025. So we've got no refinancing or credit risk for the next 2.5 years. Okay, so you've got no refinance risk. So therefore you must have interest rate risk. Well, 94% of our debt now is hedged and fixed. Okay. Okay, so then you must have an occupancy problem. Why are you so cheap? You must have an occupancy problem. Well, we're at 95.4% occupied. Okay, then rents must be going backwards. Isn't Europe in a recession? So surely rents are going backwards. We continue to demonstrate we're delivering positive rent reversion, not negative rent reversion. So these are all very positive measures. So if we can turn down to the strategy. So I mentioned before, we have a 400 million euro divestment program, of which we're on track to deliver half of that program this financial year. So why are we doing that after being in growth mode for the last 4 years? Why are we turning around and selling assets? Well, in part, it's because we have a development program. We've identified over 250 million euros worth of development projects that are already in the CEREIT portfolio. It's already assets that we already own. So we don't need to go out and buy new assets to do the developments. We're talking about rejuvenating assets that we already own. So we need capital to do that. So most of the targeted disposal program is for the development funding. The second aspect for the divestment program, for the sale program, is to ensure that gearing stays within that 40% range. Our covenants and MAS limits are at 50%. So we have over 500 million of headroom now. So on the next page, I just wanted to highlight the tenant roster. So this is really important. You're sitting there in KL or somewhere in Malaysia on the line. We wanted to demonstrate that we have 842 tenants, over 1,000 leases. The top 10 tenants only account for 28% of total rent. No one industry segment makes up more than 16%. So we're not overly exposed to the finance and banking industry. We're not overly exposed to, say, the European automobile or car industry. We've got a very diverse range. And this is something very important for our bond investors as well, to make sure that we have a very wide range and not being too exposed to any particular credit issue. It wouldn't be a presentation these days without some sort of scorecard on our ESG performance. And being European, this is something that the regulators enforce a lot on us. I draw your attention to our MSCI ESG AA rating. Why is this important? Well, institutional investors, both debt and equity, now have minimum hurdles. So many of the very large institutional investors like a BlackRock or a Nuveen, they require a REIT to be above a certain ESG score. And so we're only one of 3 Singapore REITs with such a high level of score. So while we're also showing our greenhouse or carbon dioxide emissions, this is important not just for our investors, it's also important for our banks, and it's now growing importance for our tenants. So our tenants themselves have their own carbon footprint targets, and many of their largest footprints from a CO2 emission perspective is their own tenancies, so their space within our buildings. So around a quarter of our leases now require the tenant to work with us as the property owner to reduce carbon emissions. Don't worry, the good news in Europe is the tenants are prepared to pay higher rents to achieve these emission targets. So a lot of the capital that we invest in our buildings, we're actually able to make a decent return because the tenants are prepared to pay the higher rents for us to achieve that. So I might hand over to Shane now to run through some of the more detailed financial performance and capital management initiatives. Thanks, Shane.
Thanks, Simon. So good afternoon. So I'll start with this one, even though there's a lot of numbers here, I won't go into too much detail, but because the next slide will be much easier to understand. But I think just to note here, what Simon was talking about was the NPI growth. So that's net property income growth, up by 1.8%, which almost matched the increase in finance costs, which were up significantly, but off a much lower base. I think if we just go straight to the bottom line here, you can see that the DPU on an adjusted basis. So what we've done here is we've taken out 2 properties which are going to be redeveloped. So in this financial period, they have no income compared to the last financial period where there was income in relation to these 2 properties. So on a sort of a like-for-like adjusted basis, our bottom line distribution per unit was only down by 4.5%. And that is compared to, I think, the average Singapore REIT this time, maybe 15. Around about 15%, quite often driven by the increase in the interest costs. In our case, we were able to demonstrate that the growth in the NPI coming from inflation indexation on the leases was able to at least offset the interest cost increase by about 80%. So if we turn to the next chart, so this one's much easier to understand because there's less numbers, and you can see here, this is what we call a waterfall chart, which just shows the things that impact the DPU from one period to the next. So as I mentioned, the green color is the NPI, and that's a positive gain of 0.6%.
And what's driving that? What's the makeup of our leases? Why do we get this growth that many other REITs don't get?
Yeah, so it's coming through from inflation that's in the leases. So each year, as inflation is relatively high, all of the leases are having an increase in their rental rate. And so that's driving the increase in the NPI. That's most of the increase. There is also a small element of increase coming from acquisitions as well that were completed. So that represented about 80% of the higher interest costs. And obviously, interest costs are going up everywhere in the world. I'm sure Malaysia is the same. So, we are faced with higher interest costs, but we have been able to contain them by keeping a large amount of our debt fixed. And I'll talk about that a little bit more later. So I mentioned about the 2 properties that are under development, and we received income last year that we didn't receive this year, and that represents about 0.5%. So those 2 properties are equivalent to 0.5% of DPU impact.
So think of these as being off the production line, now being redeveloped, and then next year they'll come back in to the portfolio effectively at the higher rents that we're able to achieve. So for Nervesa, we should be able to deliver a 6.25% to 6.5% yield on the development cost. But if we were to buy that building on completion brand new, we would probably pay 4.5%. So for REIT investors in CEREIT, they make a good profit for us undertaking the development while this asset is within the REIT. So yes, there is a short-term impact because we don't have the income on this property during the development phase, but when it comes back in online, when it's fully completed, it will have a much higher income because we'll get much higher rents from the capex. So it's temporary.
Okay, so yeah, the DPU is 7.79 cents. So as Simon mentioned, that's approximately a 10% yield based off the current share price of around about 155 or 54. So this distribution will be paid out on the 28th of September. So
really what we're saying to you as potential new investors, if you buy the stock by this Friday, the 18th, you'll receive the 7.78 cents. If you buy the stock on next Monday, it will be after the ex-distribution date. You'll then have to wait another 6 months before you're entitled to the 7.8 cents. So if you go back and have a look at a trading chart, most of the Singapore REITs pretty much hold their distribution after going the X date. So just something for more of the trading clients of AM on the call today. Last day of trading on a cum basis is this Friday. Next.
Yeah, so this shows the debt maturity profile. And the most important thing to look at here is that this year and next year, you see there's nothing there. That means that we have refinanced all of the debt expiring in those 2 years out for longer. So the next expiry that we have is only in November 2025. So, you see interest rates are high, but if you look at the forecast for interest rates, they are expected to decline maybe sometime next year and going into 2025. So we're in a good position on the debt. The blue line, you can see there, that is the amount of debt that we have that is fixed or hedged. And so currently we have 94% running through to 2025. So 94% of the debt is fixed. So that means that if interest rates continue to go up, then our interest costs will not be affected or will only be affected by a minor amount. So we recently did 2 refinancings. So the 2027 expiry and the 2028 expiry, these are 2 new facilities. One is for 165, which has been drawn 7.5 million recently, and the other is 157.5. So in total, over 320 million of refinancing that we've done just recently with the same banks who have supported us on these facilities from a lot earlier. Okay. Yeah, so this is what I spoke about with interest rates. So this is the interest rate forecast, and obviously you can see a little bit of forecast higher interest rate to come, but then by early 2024 there is an expectation that interest rates will drop. So if we look at the impact on our total cost of debt at the moment, we have a total cost around about 2.9%. And if the interest rate, if this 3-month Euribor interest rate was to increase by 100 basis points, then the all-in cost of debt would increase up to around 3.4. So not a significant impact on us. And in terms of the impact on the DPU, 100 basis point increase in the interest rate would be an impact of about 0.38% or 2.4% on the basis of all our debt being fully drawn. And currently we have a new revolving credit facility, the RCF, and this one, as I mentioned, is only partially drawn. If the RCF was undrawn, then the impact would be quite immaterial, only 0.09%, which is only less than 1% impact on the DPU. So we are quite well positioned on the debt and the capital management. Yeah, a lot of numbers here and a lot of maybe difficult definitions, but I think the key, Simon mentioned already. So in Singapore, we call aggregate leverage. That is just the amount of debt compared to the total assets. Even though the headline was 41.5, we sold a property at the end of June and we repaid debt in July. And so in July, that gearing falls to 39.5%. So it is below the 40%, which is a key number. And I think from our board of directors perspective, they have a guide or a policy for the gearing to be between 35 to 40%. And that gives us a lot of headroom up to our debt covenants and the MAS regulatory limit of 50%. We would have a headroom of 500 million euros up to that number. So quite a bit of buffer on where the current leverage is at.
Okay, just conscious of time, we've got a few slides here on the markets, so we'll just skim through these pretty quickly. The first just shows this track record of us maintaining occupancy around the 95% mark for the last 3 years. Even during COVID, you could see we improved occupancy. We didn't see any major dip. What we did see during COVID was a slight decline in our ability to lift rents for obvious reasons. But then since the second half of 2020, we've resumed back being able to lift rents, somewhere between 3 and 6% on expiry. In the last half, we leased around 7% of the portfolio and kept about 3/4 of the tenants and renewed them. Next. The story is even stronger in light industrial and logistics, where our occupancy is at almost full house at 98%. In fact, 5 of our 8 countries were at 100%. And getting very good rent reversion. Tenant retention is slightly softer at around 60%. This is in part because we're charging the higher rents and we're finding new tenants to pay that higher rent. Next. Wanted to highlight here that it's not just our portfolio that's running at almost 100% occupancy. Generally across Europe, there's virtually no vacancy in warehouses. 2.3% is the average across the countries we operate in. That's very low. Why is it so low? Well, the top right-hand chart shows that there's still quite a lot of growth of e-commerce as a proportion of total retail sales. We're still seeing a lot of fledging and maturing of e-commerce, and that means further investments in logistics, supply chains, more investment in warehousing, in automation, robots, etc. So we're still expecting a good 3 to 5 years before most of Europe becomes at that more mature level of penetration of e-commerce. The next page just highlights the other tailwind that we have, which is the impact from COVID and the geopolitical tensions, with a lot of onshoring and move of manufacturers to just-in-case inventory management away from the old just-in-time inventory management. So what that means is that companies now have more inventory to sales. Again, just in case supply chains get trapped again. And a really good example of this sort of move from Asia to Europe is the recent Europe Chips Act. So currently, Europe makes about 9% of the world's semiconductors. but they're targeting to get that up to 20% by 2030. Again, many industries rely on Taiwanese and South Korean semiconductors and chips. So the automobile industry, if it can't get the chips in, it can't make cars. So this is something that's very important to Europe. So we're seeing a lot of these strategic industries bringing more investments back into Europe. Next page. From an office perspective, the trend here is not so good. We're now down to about 80% occupancy. And this is in part due to the growing vacancies in Finland and Poland, where we have around 12% of our office portfolio located. So while vacancy is increasing, we're still getting good rent reversion, and we're still keeping a large part of our tenant base. And so, like I said before, there's enough growth coming out of the rents to counter this increase in occupancy, increase in vacancy. Next page. I mentioned at the outset, Grade A is very different to Grade A in other markets. And so here in the cities that we're exposed to, 3.5% is the average Grade A vacancy. Across all of the European cities and in all grades of office, it's still only 8.8%. And that compares very favorably to the Chinese cities and the US cities, which are at much higher levels of vacancy. And on the far right-hand side, it's not all a bed of roses. Our Polish and Finnish assets are sitting in markets that are more vacant than the averages. And we're looking at disposing of these markets. Next. So 20% of the whole European office stock is BREEAM Green certified, yet 40 to 50% of the leases are targeting at this more energy efficient, higher amenity, better located properties. And this chart just shows that trend in the 10 years pre-COVID to what's been going on post-COVID, really confirming this move by employers to move into buildings that will encourage their employees to come back to work. Next. So we talked about Nervesa. This is a 30 million euro project. It's on track to complete end of this year, early next year on budget. And we're really thrilled that we're now at 70% leased 6 months before completion. And to put into perspective that rent growth for platinum buildings, when we started this project, we thought we might get 250 euros a square metre in rent. We're now securing leases at 350 euros a square metre in rent. So the tenant demand for this well-located premium building, again, confirms that thematic of very large companies looking for premium buildings. Next page. So in summary, before handing over to questions, we're really pleased to be able to announce that our pivot towards a majority weighting to light industrial and logistics has occurred. We're now at 51% weighting to this very strong income growing sector. The second is that we've been able to demonstrate a divestment program at a premium to valuations. And what that has meant is it's kept our gearing below 40%, which gives us plenty of headroom, 500 million euros, to the upper limits set by MAS and our loan covenants. Because of the income growth and because of the strong asset management team, our valuations were only down 1.6% in the half. So our NAV per unit is roughly 2.30, so well above today's share price. Again, we've got 200 staff on the ground. They're able to work with the tenants. We've kept our occupancy above 95%. Very strong like-for-like net property income growth. In part, as Shane mentioned, most of our leases have inflation adjustments on an annual basis. And that's helped drive that income, which has largely offset the increase in the interest that every company around the world has had to deal with. So for our distribution on an operational perspective or a like-for-like basis to only be down 4.5% puts us in sort of that top quartile of Singapore REITs, where we've seen much lower impacts much higher impacts and lower distributions because they haven't been able to generate the income growth to offset the higher interest cost. So a dividend of 7.8 cents, that equates, like I said, to over a 10% yield. We will continue to sell some assets to continue to fund our development opportunities. They're our key priorities. Jeff, stop there and take questions.
Thank you, Mr. Shane. Thank you, Mr. Simon. Any questions? Please tap on the chat box if you have any question.
We ran through a lot of detail today, but think of logistics as a play on e-commerce and this geopolitical post-COVID onshoring of supply chains, moving manufacturing of widgets away from, say, parts of Asia and back into Europe and Central Europe. Inflation is coming under control. We're largely through the interest rate increases by the ECB, but we've locked in 94% of our debt costs, so we've kind of put insurance policies on that. And so therefore the outlook from a dividend perspective is relatively low risk.
Okay, we have a question from Gary. What will be the forecasted dividend payout for the next round and when?
Thank you. So we debated at the board meeting on Friday how much guidance to provide investors. And you'll know, as a REIT investor in Singapore, it's very rare that a company, let alone a REIT, will provide dividend forecasts. Just again, wanted to help you with the building blocks that we're able to get good inflation, good rent growth, while our interest costs have largely now been hedged. So if we go to this slide on page 11, from a building blocks perspective, the rent growth should more than offset next half interest costs. So I would still use 10% yield at $1.52 as a good guide. And I'm not sure there are that many investment grade quality REITs providing such a high dividend yield.
Thank you. Next question from Yu King. How many percentage contribution from the office leasing, the one that where income is dropping due to unoccupied space?
It's about 10%. That's the anchor to this portfolio. It's around, of these assets with declining income, it's around 10%.
Any more questions?
The Dutch office portfolio, which is our largest exposure, the income there is going up. We're getting very good rent growth coming out of our Dutch office portfolio. Thanks, Jeff.
Any more questions from the floor?
One question, Jeff, we get asked often is about our sponsor. So Cromwell Group is an Australian listed company backed by the ESR Group out of Hong Kong, and the sponsor owns 28% of the REIT. Our next largest group of shareholders are the big institutional investors like the BlackRocks, Eastspring, Perpetual, Principal, AEW. They own around 20% of the units. And then we have some very significant holdings that are public out of Singapore and Philippines, with two very large billionaires supporting the REIT as well, in Dr. Andrew Tan from MegaWorld in the Philippines and Gordon Tung out of Singhai Yi Group here in Singapore, both owning over 5%. And then we have about 5,000 retail investors that we regularly market to and talk to.
Thank you. Since I no more questions, we will call it a day.
Thank you.
So thank you, Mr. Simon. Thank you, Mr. Shen, for the sharing session. So thank you everyone for joining us. So have a nice day and a happy investing. See you all at the future event. Thank you.
Thank you, Jeff, and thanks to AM
Thank you.
Bank, and thanks to everyone for dialing in. Thank you very much.